often the best founders have relatively little experience in their domain they're disrupting. And I think that's been true for the last 10 to 20 years. But if we look forward, I think it's going to be the opposite now. It's going to be like, you don't need to be the technologist. Like, you need to be the domain expert, and you have the unique insight of the vertical that you want to attack. And I think it's the barriers now to then spinning something up are only decreasing.
The founders and teams that, yes, they've got a product that the market loves and the customers love, and they've got all of that stuff, but actually they're very good at managing the transition from individual implementation that founders are good at to one of team problem identification, team prioritization, team problem solving. Because if you can get your organization humming, you'll be able to solve more problems faster than your competition. And that's the companies that win.
These aren't people in our industry, but their perspective was, look, crowdfunding was this highly promised solution to funding for tech startups and democratizing access to this asset class. And their view was it hadn't lived up to the hype. And then some of the discussion was around, well, when I go on and look at these platforms and look at the companies on there, it's hard to get interested as an investor.
Listeners of the podcast would not confuse us with professional. So I think we're all good. Good morning. How are we?
Awesome.
It's not like you, Aaron.
How are you both?
Well, editing last podcast, I just started ranting and raving, and there was no good morning. It was a very cold start. So this time I just needed to make sure that I at least did that, because I was already into complaining about something.
Probably should listen back to the episodes.
No, don't.
Don, you're dialing in from a different room this week?
Yes, Jack. So surviving the cyclone, and when I say surviving, there's some trees down, some fencing down that I've got to go and fix, only to find that the cyclone blew open the door to my office. The goats managed to get into my office, and then the door must have blown closed for at least 2 days. And I know that there are some areas in my life that I can improve in, but isn't that the universe just taking it too far? Like, that just seems unfair.
Yeah, I don't even know what to say.
But I think we need some more context. Like, I feel like the listeners need to see just a screenshot of
the mayhem.
I might just splice in the video that I sent you, because how about I do that? Because it's not just the visual of 2 days of 3 goats of just the poo and the wee everywhere. Let me see if I can just find it here. Okay, got it. Fuck me dead. Just got to burn this down to the ground. How the fuck did they even get in here? Jesus Christ, it smells. Oh, I give up. I honestly give up. That's it, I'm out. I can't remember another time that I've been that dejected. Like, for those
Harry Stebbings doesn't have to put up with this shit.
3 days, like 2 days, I reckon, of 3 goats for the listeners at home. Just excrement everywhere. And then the worst bit, they've pulled the stuff down off some of the shelves. One of them was my Iron Man medal, and they pissed on the Iron Man medal. They've actually... They knew, and they still pissed all over it. That was actually, I got to go find. I think I'll put that in. It's soaking somewhere, but
disrespect.
Oh, I couldn't do it. But anyway, I picked myself up. Is that enough, Jack? Does that capture the essence of my pain? Should we?
Yeah, that was good done.
Just a reflection from it. From the Wednesday, we knew it was going to hit. So by the Thursday, Friday, because it was delayed, I know there have been people that have been properly affected by it. And so I'm not trying to be dismissive, but it was a bit reminiscent of COVID. And on those days, I connected with neighbours that I hadn't spoken to for ages. Friday night, one of the neighbours and the kids were swimming in the pool as the storm was rolling in. We still worked on the Thursday and Friday, but I don't know about you, but I prioritized the really important things, and we still worked on deals. We still worked on a few things, then got to spend time with the family. Okay, well, we didn't have power and whatever else, so standard of living was down, but people confuse standard of living with quality of life. And actually, done well, the quality of life of being able to connect with the family more, the neighbors, helping out others, playing in the rain. My father and brother came over and we did cyclone tie-downs in the roof together. Like that, it was just good.
Yeah, I agree. We had some of Marin's family out from Germany, and on the one hand, I felt bad for them because their week in Brisbane was spent mostly inside with this promise of a cyclone that didn't hit Brisbane, but also was so wet. They didn't get a chance to really see much, but it meant we got a lot of time together. And the kids were like super excited. And it was a good bonding moment. But then also it did have reminiscent, like COVID, just the way the Facebook community groups lit up. And
how insane are Facebook community groups? If AI reads these groups, AI will wipe us out as a species, because surely no one can be as fucking dumb as half the stuff that's posted in these groups.
I just question how, what happened to Darwinism? Like, how, but also look, there's some beautiful moments in there. There's some great community support, but then just the randomness. But anyway, we got off scot-free. Really feeling for some friends on the Gold Coast who were pretty impacted.
So Sunday, right? We've still got the end of it. It's still pissing with rain. Let me just find. Oh, they've deleted the comment, because I re-downloaded Facebook because it was getting all of the updates, and now I must admit I'm sometimes I'm back into meme K-holes, which is why today's Sharts it's a little bit stretched. Don't scroll down there because you'll talk me out of it. But anyway, someone on the Sunday was like, does anybody know why the power is out and why Energex haven't got it reconnected? I couldn't help myself. Like, evil people and dumb people flourish when good people stand aside on Facebook groups and don't wade in. That's my other lesson.
Justification.
And I was respectful. I just asked some questions. Is it like, do you mean like why the lines on the ground, or why the trees are on top of the lines, or why are the trees down because of the cyclone we've just had, or the fact that it's so unsafe because of the flooding, you can't actually get anybody to our area? Could you give me some more detail on the question, please? They didn't. They were very rude. They didn't respond to my request for a different information. All right, shall we get onto something?
Probably should. Well, meanwhile, Ash is over in India, having what looks like time of her life with a friend's wedding. Looks epic.
Looks amazing. The colours that they pull off. It's like it's literally the Wizard of Oz.
It looks, the colours just seem so much more vibrant. Looks sensational. But I am looking forward to having Ash back next week, just to keep us on track.
The only problem is when you have those really great trips and those really great experiences, you tend to reevaluate other parts of your life. And I think there's a greater than zero chance that she might reevaluate us three morons, but we'll see. Well, two plus one.
3.
Looking forward to having you back, Ash.
Yeah.
I thought we might just touch base on what's happening in the public markets in the US, because when Elon is scared a little bit that he has to get the president of the United States to buy one of his cars from the Oval Office. Did you see that this morning?
I missed that.
So Tesla's sales are getting absolutely smashed, mainly because Elon's a dick, and plus there's so much Chinese competition coming in, plus every other manufacturer is getting their electric platforms. He got Donald Trump to do a little sales thing this morning from the White House of Donald buying a Tesla, and because we need to support Elon. I have a feeling that's going to backfire, given the people that were Tesla buyers leaned a little bit left and don't like Trump and now don't like Elon. I just don't see how this plays out. But yeah, the NASDAQ and S P have started to break the back of some of their trends. So I've just got some charts up here. It's only small, but what happens is once a market starts to make lower highs and lower lows, that's normally the sign of a trend reversal. And Tesla has had the biggest fall. Tesla's almost down 50%. Where's the chart? Maybe I don't. Yeah, it peaked at over $400 and now it's nearly $200 in a very short period of time, down 50%. So the market knows something's coming. Now, it's something that Ray Dalio's used for a long time, but this company that I follow called Hedgeye use it. But this is effectively a 4-quadrant model that looks at growth and inflation. And so for those at home, what I've got on the screen is this quarter by quarter. The white numbers are the historical and the blue numbers are the forecast. And all it's doing is saying, okay, well, if growth was 2% and inflation is 3%, Well, that's accelerating growth, accelerating inflation. That's what they call quad 2. But then there's quad 3, that's bottom right, where inflation is accelerating, but growth is decelerating. Then there's quad 4, where both inflation and growth are decelerating. And then there's quad 1, where growth is accelerating, but inflation is decelerating. Like quad 1, they call Goldilocks because things are growing, but they're getting cheaper, right? Quad 2, where things are getting more expensive, but we're still growing. Quad 3, things are getting more expensive, but we're going backwards. And quad 4, everything's going backwards. And the problem with this is that it's hard to forecast, but easy to see in hindsight. But when you look at major market shifts, they are between these quads. And the market has started to recognize that with Trump's tariffs, we were in a quad 3 environment towards where inflation's going to go up, which could kill growth. And then the fear is a quad 4 environment, which isn't good for anyone, where growth decelerates and inflation decelerates. And the first thing that gets hit is always tech. You have a look at environments and plot it back 30, 40 years. You do not want to be in tech in a quad 4 environment where inflation is decelerating and growth is decelerating. You don't want to be there. You want to be in bonds. And so I think it's just important to not try and forecast the market. And for the YouTube listeners, here's the highest and lowest expected value by the quad regimes. So if you're listening to this, check out the YouTube one because it'll tell you what assets perform best and worst in these different regimes. But like I say, it's very difficult, if not impossible, to actually forecast what regime we're going into before the market has. What we do know from 2022 and also 2019, in the wrong environment, tech gets smashed in the public markets. That then flows onto us, right? That flows onto us in lower multiples and less appetite for people to invest in tech. And so if you look at what Trump is doing with the tariffs, if economists are right, it could very well lead to a higher inflationary environment, but a decelerating growth environment. That may work out for the US long term, but it certainly ain't good for everyone else. I think it's just important to understand. Now, what has some people in the market shitting themselves, and this is Hedgeye as well, is that February was actually our first deceleration of inflation in the US, and they're forecasting that it's going to continue to decelerate. And when that decelerates, if growth decelerates at the same time, it's not good. Now, you can't just take one factor in a model. What's the yield curve doing? And if you look at the 2-year yield curve, it's dropped as well. It's gone from nearly 4.4 down to 4 or 3.9. Now, it doesn't sound like a lot, but for the 2-year yield, that's a big deal. So the bond market is saying actually in the short term, we can see a deflationary environment. And when you then have a look at the VIX, NASDAQ volatility, and also the OVX, they've all had a spike as well. And so there's a few different signals out there that say this isn't just a market one-off. We may actually be entering a regime change. And if we do enter a regime change and we see tech continue to sell off, like we saw in 22 and 23, that affects us here because there's less investor appetite and your valuations get smashed. I'll just pause there.
Yeah, I think this is a really good topic. I love the Hedgeye quads. I actually have it printed on my wall as a reminder. But the bit for me, Don, that first chart you had, Hedgeye forecast for quadrants, like just the rate of change there, like the jumping is phenomenal.
Well, it's such an uncertain environment at the moment from forecast point of view, with the president talking about tariffing the shit out of everything and then being a flip-flopper. And the problem is what markets and the economy hate is uncertainty. So we are going to tariff, we're not going to tariff, we are going to tariff, only a small amount. Uncertainty kills the market. And that's why where a lot of people think Trump is going to do a huge amount of damage. I actually think the markets will be the stabilizer. Like, he's a money guy and he's funded by money people and he's surrounded by tech people. And if everybody's share prices are getting smashed and the economy starts to turn, I think you'll find that it will self-stabilize and him and Elon will have a blow up. I think the market will wag the dog in this. Mm. Now, this is a chart going back to 1964 of a reminder of the drawdowns in the S&P 500. And there's a lot and they're often big, but you can't get too cute. Here is, if you put $10,000 into the S&P, just the regular S&P, like $10,000 since 1960 turns into $1 million. Or I'm not sure exactly what the total return bid is, but I think that might just be tech, that 10,000 turns into 7 million. So, trying to forecast and get too crazy or buy in, buy out is a little bit daft. But as founders and a VC that's raising its first fund, it would not surprise me in the universe that I live in that the universe wants to test our resolve by another brief ice age before we launch this thing. But let's not tempt fate.
Yeah, let's be positive. But no, it's good data. I mean, you've been showing different charts and Sharts for a while now, Don, talking about the heat in the system. And as much as I just said before, like the rapid change that we're seeing in this data, it has been building for a while. Like there is that fuel in the system. But it's going to be interesting. I think it's hard knowing what will happen next with Trump at the helm. I guess that unpredictability that we're seeing represented in the VIX and everything else.
Uncertainty leads to fear, and fear then drives all sorts of weird and wonderful things. So we'll see. All right, a little item that's a bit of a recap. We had in a previous episode talked about Kirstin Hunter becoming an interim. I think what was the role described as? A transitionary CEO lead or something like that?
Yep.
Well, it's now been announced that she is taking the CEO role. So congratulations on that. The press release said Birchal has facilitated more than 218 million in investments across 300 successful offers with a community exceeding 318,000 members. The platform commands more than 80% of Australia's crowdfunding market. Some context, Kirstin joins Birchal with significant experience in the startup and investment sectors, having previously served as co-founder and chief executive of Future Super and managing director for New South Wales at Techstars. During her tenure at Techstars Central Sydney Accelerator, 83% of startups in the 2024 program had at least one female founder. Crowdsource equity has a crucial role to play in building a thriving ecosystem in Australia, Hunter said. What really excites me is crowdsource equity increases the economic power of retail investors by taking business funding decisions away from a small number of professional investors and placing it in the hands of community. Well done on that appointment. Word on the street is that there is some acknowledgement by some of the shareholders of crowdfunding entities, including Birchal, that whilst it is a positive part of the ecosystem, we've discussed in the past some of the things that we think are not so good about crowdfunding. We've got to be careful not to be talking our own book, but companies that shouldn't be on platforms, being on platforms, awful valuation situations, very poor investor protections, extremely poor investor communications, and hopefully some new blood coming into a role at Australia's largest crowdfunding, supported by some of the shareholders, might be able to work to resolve some of those.
It was interesting. I was on a call yesterday about the legals of AFSL licensing and whatnot, and Birchal came up, someone referenced it. And hearing the group talk about it, it was clear that they're definitely the leading brand, right, in Australia. They're the most well-known. People in that call couldn't actually name another crowdfunding site. These aren't people in our industry, but their perspective was, look, crowdfunding was this highly promised solution to funding for tech startups and democratizing access to this asset class. And their view was it hadn't lived up to the hype. And then some of the discussion was around, well, when I go on and look at these platforms and look at the companies on there, it's hard to get interested as an investor. So I think it's one of those things that it's absolutely needed in the ecosystem. It's got huge potential. It is regulated, but at the same time, I think like all aspects of these things, there's some big areas for improvement, and we've seen some of the adverse outcomes, if I put it that way, of people using these platforms. So, but I'm excited for Hunter joining. I think this is great. It's going to be interesting to see where it heads next. Yeah,
we had after our last episode where we talked about crowdfunding, we had someone from one of the other crowdfunders who's an executive there email in with their perspectives. They said that they hadn't heard of crowdfunding is a place to go if you want to get a silly valuation. I said, okay, well, now survey all of these other investors. And for us, we had a portfolio company specifically go there and get a valuation that was, 3x what we had done 6 months earlier. And that just went straight through to the keeper. So those kinds of things. And then they ended up raising an amount that wasn't actually enough to execute the plan. Like those are the little issues. We talked about valuation, and no, you can't do extreme forecasts, and we get it. But being silent on valuation, not even attempting to just say, look, this is where the valuation sits relative to these other things. I still believe in personal choice. I still believe in personal accountability, not trying to baby anyone. But when you're totally silent, because in our instance, when I say our instance, the company that we're an investor in, there's not a metric on the planet that could have justified that. And that would have then been an automated stabilizing mechanism, because you would have then had to have, I don't know, recalibrated. So you looked a little bit more reasonable. These are the things I think they can work on. I think these are solvable, and I'd like to see them solved. Even the platform taking maybe some accountability to drive some level of updates. So then that way the next communication you get isn't from an administrator telling you that the company's fucked and your equity's gone. There's probably a few steps before that happens.
Yeah, that was my experience. Exactly that.
I think that's the hard part. Like right now it's misaligned, like the interests, and the platform's incentivized to just keep doing volume of deals because that's where their revenue source comes from.
Yeah. And again, we got to be careful because we've got our own situation, but we only make real money and kids start going to private schools if we get an exit, and a good exit, and that we return over an IRR to investors, and then we get a small percentage of the amount above that IRR. So is there a way to better align the incentives of a platform so then that way they at least have a horse in the race?
It's a really good point. And then at the same time, like, do want to acknowledge even our carried interest does potentially cause us to take riskier bets if we believe the upside is bigger. But I do think alignment of behavioral incentives is what's at play here. I do think it's ripe for improvement. But I don't know, does that come from the regulator, or is that driven by the platforms themselves?
Yeah, I think it's got to be driven by the platforms for the longevity of this industry. If we want a commercial private player, it's got to be driven.
Yeah, I think you're right.
Yeah, that would be the ideal situation, whether that can occur. But we'd love to see it, because I do genuinely think, done well, it should be a partnership at different stages, especially seed and pre-series A. There's no reason why I can't partner with others. But in one example that I raised to the person that had written in, it's a well-known company in an ecosystem that has the who's who of investors on there. They haven't found product market fit. They've run out of runway. Nobody's willing clearly to support from the existing investor base. Next minute, they're on a crowdfunding platform, and none of that stuff is discussed. Now, I know it's difficult, but what you wouldn't want is retail money going into the last hurrah and the thing ending up being administrated. But then at the same time, that whole thing comes from a position of arrogance, like we actually know what we're doing, like we miss good deals all the time, and let's have some humility. Just because this is our vocation doesn't mean that professional, in inverted commas, should be the be all and the end all. So it's difficult, right? So I want to acknowledge that.
Yeah, absolutely.
Listeners of the podcast would not confuse us with professional. So I think we're all good. All right. Now, there was an article earlier this week, I think, in Capital Brief, which at the time I saw the name Elaine Stead and then Capital Brief, and I'm like, hang on a minute, my brain. But it was great to see Elaine getting an article of hers published in Capital Brief. And it says, the startup lessons Australia still struggles with. Australia still treats startup failure as a fatal flaw, but it's a crucial step. To build deep tech success, we need to rethink how it's viewed and embraced. Did you get a chance to have a look at it?
Yeah, really good article. Great to see it picked up and published broadly. And such a good point. Like this is something that it's a conversation we need to have as a country, because I think we are losing this race, and there's cultural elements to this. There's, I think, just history to it, but an important topic. And
I think what I like about it is it's an investor. So let me get it right. It says Elaine Stead is a principal at Main Sequence, Australia's largest deep tech fund, and the company that she's talking about is Gilmore Space. And the article says has finally received its first launch permit. She says, I'll save you the suspense. We already know it's very, very likely its first attempt will fail to reach orbit. No similar company has successfully reached orbit on its first try. Most early launches fail to lift off, explode on the ground, or falter in transit. What I partly like about it is an investor getting in there early to provide some cover for their founders. Whilst there are some publications that are supportive of the ecosystem, we know some aren't as much. And so I like that fact of an investor putting their head above the parapet. She goes on to say, one of the defining characteristics of startups and venture capital, particularly in deep tech, is an acceptance of failure. A better framing would probably be a tolerance of failure. It's not that failure is a good thing per se, it's just understood as necessary to be part of the progress. Pushing the boundaries of new technology or attempting to create an entirely new industry requires extensive experimentation. There was a bit there where she goes on, she says, in my 20 years as a VC, I can count on one hand the number of companies I'd consider reckless with investor capital. Most companies fail because they run out of money during the experimentation phase. Sometimes the technology doesn't work. Sometimes the competitor just gets there first. More often than not, it's the company that never truly lands that elusive product market fit where what they're selling and how they're selling it creates an undeniable pull. But in Australia, failing even well is still treated as a punishable offence. And by failing well, I mean we had a bold vision, we tried our best, and despite that, it still didn't work. We learnt a lot, and hopefully the industry and sector learnt something too, something that will make the next attempt by others easier and less costly. We know many of these companies we will invest in will fail. Some will fail early and fast.
Yeah. So many points in here. Failures are absolutely a necessary part of innovation. But the way failures get reported in the Australian media, there's a disconnect there. There's not that understanding, and often the player gets criticised. And even in our culture, even those that are successful who haven't had a failure actually get chopped down by the media as well. So I think there's a cultural element. I think the media plays a role. I think as well as Aussies, we think we tend to pride ourselves on being direct and calling a spade, but actually, when you spend time in other innovation ecosystems, you realize how much we are backwards in coming forwards. I think when I look at places like Israel, like Silicon Valley, they have a directness in conversation. They're able to give tough feedback, but still, even with that toughness and that kind of direct feedback and quite blunt, they are still more accepting of the failures when things don't work. And it's less about labeling the founder as a failure as opposed to, no, well, they tried these things and these things failed. And I think that those nuances are things that we have to learn from. I think it's great to have someone like Main Sequence Ventures playing in the deep tech space and having investors like Laney and I think of Phil Maul and Mike and others who understand this and understand that these risks have to be taken by these investors in order for Australia collectively to benefit. I just wish the media could catch up. I wish the way we talk about failure changed. I wish we adopted some of the practices out of other ecosystems where they openly talk about failure and the lessons learned from it in a beneficial way.
And I think the nuance is if it's been a bad failure, as in bad behaviour and whatever else, as far as I'm concerned, you should be hung in the town.
Call it out.
Yep. But a good failure, as described in this article.
Yeah.
Jack?
Totally.
I don't really have anything to add to that, Don. I think that was a good combo.
I'll put a link to that article in there. Now, another article in Capital Brief this week. I think Capital Brief must be like increasing non-employee journalism because this also was from a VC in the Australian ecosystem, Ellie Hansen. Ellie is a principal investor at SideStage Ventures. SideStage hit it out of the park with Leonardo, didn't they?
Yep.
They achieved greatness. It says, why taste, not tech, will be the advantage in the age of AI. That headline really grabbed me because one of the things we've focused more on, it would be fair to say, is actually if you strip down evaluating founders, it's the ones with great taste and execution that are the ones that win. Your grandfather doing some renos, Jack?
Yeah, sorry, I'll go on.
That's all good. Well, just how's he going? Quick update.
Yeah, we're going really well. We're hoping to paint this weekend, but I think he said we're going to have to push it because he's just not going to have it all ready to start painting on the weekend.
So that's either an orbital sander or a planer.
Yeah, I think he might be planing. He was doing, when I went in there before, he was putting like the architraves around the window.
Oh, wow. How good is it? Yeah, the more we look at founders, good taste and good execution. And let's call a spade. When it doesn't work, it's often either bad taste, so bad decision making, bad ability to evaluate, or bad execution, or both. And so what this article, and it's quite a long article, so I've just taken some of the key bits, but what Ellie says is AI is everywhere, but creativity isn't about volume or efficiency. It's about making choices. As the world is flooded with content, the real edge is taste. There's a familiar kind of panic that comes with a new technology, especially when it feels like it threatens something uniquely human. When we first saw the photograph emerge, surely painting was over. When synthesizers arrived, surely real musicians were doomed. Now we're here with AI, we're having the same debate about creativity. However, she goes on to say the real differentiator and the thing that creates value is not the tool itself, which I totally agree with. It's the thinking behind it. It's the ideas. There's the old saying in venture capital, bet on the jockey, not the horse. The idea is that a startup success hinges more on the founder's vision and execution than the technology they're building. That sentiment feels increasingly relevant in this moment of AI acceleration. Outlier founders and companies will be those who identify genuine human problems and devise ingenious, transformative ways to solve them. For investors, in a moment where new AI startups are minted by the minute, your taste becomes your compass for navigating this paradox of choice. Taste is your instinct for what truly cuts through and potentially holds real future value. Honing it in isn't optional. It's actually mission critical. Like 100%.
Yeah, I agree. I think the slant I'd probably put on this is we'll have more time for taste. So like when I think about how much of work and most work that gets done is not actually in the creative hemisphere or the taste-based, it's just the doing of things. And if AI can take that away, yes, taste becomes the skill set, but also we'll have more time to be operating in that mode, if that makes sense.
Well, but the end users of the AI product mostly, but for us, aren't we in a whirlwind of it's all moving so fucking quickly that we've actually got less time?
At the moment, but I think that'll plateau, won't it? Like, won't there become a point where AI we just reach AGI and everything's agentic and we just have all this time back?
Yeah, but in 1988, what was that thing? World Expo.
Oh, World Expo, yeah.
One of the themes of that with the computer coming out and all of these things, what are humans going to do with their time? And we're now busier than ever because at the core of it, we're degenerate animals that can't control our emotions, right? So why is this round going to be any different?
The only thought I have there is if we see the collapse of the financial system as we know it, because we end up at universal basic income. And so our concept of exchange of time for wealth and productivity building becomes irrelevant.
This conversation has escalated quickly.
It's a good point. I 100% agree with you. Like our pattern with technology is just increase efficiency and productivity to then fill up more of our time with more doing. I totally agree with that. But surely at some point that has to plateau, or are you saying, no, humans are this way for other reasons and that behavioral characteristic will stay?
I think so. Like, I think these ideas of utopian worlds don't actually exist because humans have these innate impulses that come from the way we've evolved, and we just tend to find a different rat wheel. But let's break it down. Let's come back a little bit. We have to find founders that we can deploy our own capital and our LP's capital to get a return. And now that in the past, you could decide to choose 2 or 3 types of tech or maybe decisions. Now it's 100. So having really great taste as a founder to be able to develop an executive team, to be able to develop a culture, develop all the things required to make those decisions at scale. And then for us, finding those founders is what's got to happen before that point of we're sitting plugged into the matrix running a Charlie Booker episode. Jack, tell us where we're wrong.
No, I do agree, Don, with what you're saying, and I think it applies to whether building a team or a product. Like it's that first 80%, which AI is going to be able to do very quickly for you, but it's that last 20% where taste and all that hard work of making sure the product is all the right workflows for the end user. So yeah, I absolutely agree.
To your point about how we invest, this is why we look at the founder behavioral characteristics and behavioral aspects in the team, because more so than the product, right? But what we're looking for are these behavioral characteristics and the change loop management, back to your point, Don, like founders' ability to navigate these rates of change and all these tools and everything else coming through is where we see the differentiation between those that will do well and those that will do mediocre or poor.
Yeah, well, great article by Ellie. Now, along a similar vein, there was a post by Paul Bassett. I think everybody knows Paul, co-founder of SquarePeg. His post said at SquarePeg, we're spending a lot of time thinking about what remarkable AI native founders look like in terms of capability and mindset. All of our views at the moment are very highly held and open to being challenged and are conditionally evolving. In that context, he's asked for feedback in the comments below. The starting point is in many respects, great AI founders are going to look a lot like non-AI native founders, but there will be some differences. He goes on to say, when we started investing in fintech a decade ago, we decided great fintech founders would look a bit different to other founders. Often the best founders back then have a relatively little experience in their domain they were disrupting. They formed a view that in fintech, great founders would typically require both deep understanding of the specific market and financial services they were disrupting, as well as all of the other characteristics of a great founder. Then there is perhaps the analogy for AI. Given the pace of change and the uncertainty of how both technology and business models will evolve, his sense is that founding teams need to have an incredibly high level of strategic agility and raw horsepower and a very deep technical understanding of AI immersion. They need to be able to ship incredibly high quality product and do it in an unprecedented velocity. And they need to possess strategic insights that the rest of us don't possess. The degree of difficulty is incredibly high, but the rewards are remarkable, which I think comes back to, again, they're going to need to have great taste in that decision making and great implementation and execution. But I do think it's a bit like in the prior world, if you had a basic tech startup, you really need a technical co-founder. And I've been burnt with some investments where I didn't have that technical co-founder. But here we're seeing a lot of founders come to market that don't have a co-founder that is really in the weeds of AI, and they're relying on external either consultants or contract workforces. And if you don't have that on the founding team, I think that is actually going to be a challenge. What are our thoughts on Paul's positioning?
Do you want to go first, Jack, if you've got a bell?
Yeah, the first thing that popped out of my mind there was often the best founders have relatively little experience in their domain they're disrupting. And I think that's been true for the last 10 to 20 years. But if we look forward, I think it's going to be the opposite now. It's going to be like you don't need to be the technologist. Like you just need to be the domain expert and you have the unique insight of the vertical that you want to attack. And I think it's the barriers now to then spinning something up are only decreasing. So Don, I do agree that like having a technical co-founder only increases the odds. And if you've got a choice between having someone with technical skills or not, you always choose to have the technical skills. But I just think founders going forward are going to possess more of the domain expertise as opposed to the technology.
And one of the reasons why we like co-founders, even though there is a risk of destructive conflict, is that, as we've discussed a number of times, you've got to produce results, you've got to administrate the back office, you've got to entrepreneur new ideas, and you've got to integrate vision and mission. And when you're a sole person trying to spin those four conflicting hats, it's a nightmare. If you're two people and you can divide those hats like Jobs and Wozniak did, the Atlassian guys did, insert great company here, that's one of the primary reasons, adding into that technical ability.
Yeah, I think if you zoom out, so Paul's point, if you zoom out and ignore AI tech and just look at all tech trends, I don't think the ingredients that are necessary for founders to be successful have changed. They have to have that understanding of the technology trend. They have to be on top of the latest XYZ, whatever that is. But I think there's a nuance in what you said, Jack. I totally agree with around, I think what's changing is the barrier to entry. So now, whereas before founders could be low on those skills and still be successful, now I don't think that's true anymore. I think it's only going to be the top founders who will actually succeed. And I think that the kind of core level entrepreneurship, I think that middle ground, I think they're going to struggle to succeed in a landscape that's changing so quickly.
Yeah, agreed. And I guess with the landscape, I'll put the link to Paul's post there, and if anybody wants to give feedback on that post, I think that would be good. But I guess part of the theme here is like success and failure and trying to pick it. And there was a post during the week by John Rush. He said, "Why startup founders fail?" He says, "Based on my own failures and 100 founders in his network, I thought we could just rattle these off quickly. A solution looking for a problem. Check. So often founders fall in love with something and here's a solution, but actually the problem doesn't actually exist. They like it, but they won't pay. Oh, that one hurts. Oh, I love this. Yeah, it's not worth that much to me. That often happens to vitamin products. Failing to monetize B2C. It's not really our space, but I think that does happen. Raised VC money for a non-unicorn idea. Yeah, that can be a challenge. You get to your cap table with certain types of money, expecting certain things, but the market and the product can't deliver it. That is not a space to live in. Wrong co-founder. When two people start a company and one quits, the other one isn't that crazy about working their asses off for the startup, quite often in his experience. So most startups I know that lost one of their co-founders failed early. I think co-founders bring more risk than upside. I disagree there. I think co-founders, if you have the right recipe and you understand certain things and there are certain behavioral temperaments shared and certain values shared and certain visions shared, I actually think it beats. But you've got to have those other ingredients. If you don't have those other ingredients, you're one fuck up away from breaking up.
Totally agree with you on that.
Small market. He says in Norway, where he spent most of his life building startups, most would start with a local market. I thought that was smart, but in the aftermath of 15 years shows that it was the reason for the downfall of the Norwegian startup ecosystem. Yeah, I think there's a nuance there. Start niche, but make sure that you've got a big enough niche. I have no problem starting and say Norway, but as long as it's actually a problem outside of Norway. But if it's only a Norwegian problem, that's probably not going to get you.
Yeah, great. Niche and tilt.
Yeah. Outsourcing. I agree. Not for everything. He says, think of it as like hiring someone else to raise your child. I think some things can be outsourced, like your back-end admin, bookkeeping, whatever else, but probably not your tech development. Vitamin, not a painkiller. Discussed that earlier. No passion for an audience and field. Yeah, if you're just doing it for the money, I don't think that works. A lack of focus. Yeah. Not using your own product. It's an interesting one. I guess we use our own product when we invest in our own deals. So I think we're okay.
That's an interesting one. Not using your own product.
You're not supposed to get high on your own supply, though. Is that a different issue? Not validating.
I don't know how I feel about that.
Yeah.
Yep.
No, but that's only if it makes sense, right? Imagine if you're the founder of Xero, but you don't do your books on Xero. Use Myobi. It's like, really?
Yeah, okay. No, I get that.
May I just pause there for a second? Myobi.
I
fucking love it. You definitely drive a Subaru, don't you? I'm going to call it that from now on forevermore. Betting on bet on non-organic growth. I don't really know what. Didn't plan for a marathon. Totally. This game is hard. That's why I say at the beginning around the markets, like you better plan for a marathon here. And even then, just ran out of money. Yep. Not willing to learn. 100%. The founders that we see that don't succeed have a lot of below the line thinking and they're not willing to learn and pivot. He then says, that's it. I'm not sure it is it because there was another post where, and I'll put this on, this was by Dharmesh Shah. He's the founder and CTO of HubSpot. And he talks about work-life balance. And he's got a Venn diagram, right? Work-life balance on one side and a breakthrough startup on the other side. But he's just saying, don't expect the circles to cross over in the middle. If you want this, the idea that you're working 9 to 5, 5 days a week, and true work-life balance, I think is bullshit. And I listened to the podcast with the founders of Cursor, or one of the founders of Cursor. Was he on Stebbings, was it? Did you listen to that one?
Yeah, was it Stebbings?
Or maybe it wasn't. Maybe it was Stebbings. 18 hours a day, 6 days a week. So they've got a small team, but literally if you aren't interested in working 18 hours a day, 6 days a week, and then he says, we don't want people working on a Sunday. But their culture is like, if you're not willing to do that, you're not getting employed by Cursor. Now, some people will rail against that and say that's either not required or not possible, but I don't know any really high work-life balance founders and teams that achieve breakthrough stuff. Like, yeah.
I've got to jump, but yeah, Don, I didn't realize that's fucking wild. 18 hours a day.
Yeah, listen to the podcast, and he's very ingratiating the way he talks about it. He's just like this. I knew what we would need to do to build this company, and not only that, they do a 2-week trial, and just to see if you're gonna. Yeah. So.
Yeah. Wow. All right, guys. I'll chat later on.
All right,
Okay.
Jack.
See you, buddy. Yeah, I know there'll be listeners. Well, maybe not listeners, but I know people who would rail against this. And I think it's just that recognition that it's okay if you don't want that outcome and you prefer to balance the other way. But for those that do, and every organization, every startup has a different culture. And so select into the culture that fits you rather than critiquing those where you wouldn't fit.
Yeah. And understand the consequences of trade-offs or not. So a lot of these things are around, again, success and failure. And there's a guy on LinkedIn whose name is Jack Kvecki, and he's a menace, and he posts a lot of random stuff. But did you see that he created a product on Product Hunt called "Is My CEO a Fraud?" So I put myself in there, and I got a rating of 5.3 out of 10. Now the 10 is rated in Sam Bankman-Fried's. So I got 5 out of 10 Sam Bankman-Fried's, and it says, your profile screams business seminar enthusiast as loud as your cheeky smile. Investors and co-founder, that's a dangerous combination, like putting Kanye West in charge of diplomacy. You have more companies than I have socks, and I'm pretty sure they smell just as bad.
I did put mine in. I got 3 out of 10 SPFs, which means I'm near NPC. Like I'm just I'm a non-person player in all of this. And I did capture what it said. It was gold, but I lost it. But it was basically criticizing my shirt for blending in more than my personality? My personality's probably never stood out anywhere, and I lack any charisma.
I'll put that link in there. Now, we've run out of a little bit of time, but I'll push it to next week, but there was a post about building a brand on LinkedIn. It's probably one of the best playbooks that I have seen. The problem is most people don't have the temperament or the time or the whatever else to do it, but I'm going to push that to next week. And I think next week we'll talk about some of the deep fake videos, but some of the stuff that is coming out now, I have no idea how we're going to trust anything online. But from a point of view of creating really high value content, I think there's some opportunity there, but you can change all sorts of things and it's just indistinguishable.
Yeah. I'm looking forward to getting into that one. My social feeds now, I see reels that are AI generated, but the difficulty in distinguishing what is and is not generative is getting so much harder.
All right, theme of the week.
I have one around context switching. But let me just switch context with some news of the week. So we awarded, just for listeners to round this out, we awarded 2 funded places for female founders on our US mission. So we shared in previous episodes that we were looking to fund 1, but we've funded 2, which we're stoked about, and we're taking off soon. And I just want to give a shout out to Bo from Astrius Labs for coming in on the back of that and actually offering a tech DD service for one of those applicants as well. So he sponsored that service for them. So it's good
That's great. I'm glad you're able to catch up with Bo down in Adelaide at South Start. Unfortunately, I missed getting down there, but Tech DD is one of these important things, and we're going to try and understand it a bit more.
Yeah, totally. So yeah, shout out to him and thanks for that. But yeah, so my reflection of the week is context switching, which really came to a head in the cyclone, like looking at things going on and juggling news and capturing information. And I'm someone who's had this merged inbox of all of my email accounts going into one and all my calendars going into one, thinking that was efficient, but actually just completely separated them. And I've noticed a productivity uptick in just being focused in one context. So having my tribe inbox separated from my personal life stuff. And I've adopted this great little tool called Browser Do, which is an AI plugin that takes control of your browser, and I've set it up with its own browser, and just getting it to do more tasks that would otherwise take me out of productivity. So
yeah, wow, I'll have to have a look at it. Can it work
it is on? So good.
If you need an Apple,
it's a Chrome plugin. So if you've got Chrome or Brave installed, so I've set it up in its own browser because it does need focus, so it just runs. But I'm getting it to find missing receipts. I'm getting it to look at flights. I'm getting it to look at accommodation, car hire for when we're in Sydney tomorrow. All these things. And you just set it off to do a task. It was doing a review of our website. It's awesome. It's got some limitations. It's still early, but yeah, for me, context switching and just how much we lose in not having deep focus time. So just going back to that model, structuring deep focus time in my calendar.
Yeah, great. Yeah, for me, the theme, I'm still trying to do portfolio work and still working on different things, is that like fear comes from uncertainty. And sometimes when you've either haven't experienced something before or a lack of planning and in cultures, often that fear is because you're not getting on top of problems fast enough. And so some of the portfolio work is often just running a bit of a mental exercise where we get them to write down all of the issues in the business, like just write them down, problems, issues, things that aren't solved. And generally, if founders listening, if you were to do that, I bet you'd be able to come up with 30, 40, 50, 60 issues. The website's not up to date. I'm not using the CRM effectively. My capital runway is going too short. Like, you just write down all of the issues that you have in your business. You can get quite a lot of them. But often the biggest issue isn't the individual issues. One of the first things is, in the majority of cases, no one person in the business can just go and solve it. When you look what people write down at a certain stage, so you need to have some revenue. I'm not talking about for pre-seed, because in pre-seed, you are the business, so it's all on your shoulders. But once you've got a team, what you tend to find is that the issues you're writing down are the issues that no one person can solve. And so what's actually happening is that we have a bit of a managerial problem, because if no one person can solve them, but they are solvable by the business, then the issue you actually have is you've got an inefficiency somewhere in identifying and solving issues as a team, right? And what happens is, if that problem goes unsolved, as in you don't upgrade your managerial process to become better at team problem solving, because that's often the transition. Founders get businesses off the ground and they're really great between them and their co-founder and maybe a core team of people of doing lots of stuff, but then they run out of capacity. But actually, if you can upgrade the ability that, you know what, we can run day to day, but we're really good at identifying issues that need multiple people to come together and solve, that's actually one of the superpowers. And when we talk about execution, that's where we find a disproportionate outcome. The founders and teams that, yes, they've got a product that the market loves and the customers love, and they've got all of that stuff, but actually they're very good at managing the transition from individual implementation that founders are good at to one of team problem identification, team prioritization, team problem solving. Because if you can get your organization humming, you'll be able to solve more problems faster than your competition. And that's the companies that win. And so that for me has been the theme of the week, of just reminding portfolio and others. So anyway.
Yeah, that's a good one.
Let's get into some charts. I did promise last week a few weird and wacky ones, so we'll see, but they start off really boring. So with Trump coming in, and I think there was an article by Main Sequence as well of just the effects of the budget cuts that Trump is doing. This is the share price either decrease or increase following Trump's cuts. And there's only, 3 companies that have gone up. Everybody else, share price has fallen by 5% down to 40% because the government has cut heavily. So you've got to be careful how much you rely on public dollars because they can change quickly.
Yeah, that touches on what Jason Seed was talking about for that sector when he was out.
This is a pie chart. So there's a secondary deals website called Sidecar in the US. It's nearly 50% of all transaction volume on Sidecar is OpenAI, Anthropic, and SpaceX. The other 50% is everyone else. But it just shows the huge demand for those three companies.
Yeah, wow.
This is a chart of AI investment surge compared to the dot-com and crypto booms. So this goes back to 1998. Have a look at the dot-com funding in billions. It's a pimple on a backside. Then even have a look at the crypto boom before collapse was less than the dot-com. But for listeners at home, AI funding in billions is a exponential up and to the right curve that dwarfs the previous dot-com booms. Now, keeping in mind this is nominal dollars, so you've got inflation and this is not a nominal. This hasn't been normalized, but have a look at the dollars flowing into AI.
That is phenomenal. And no signs of slowing down. Like, that's accelerating.
That is no signs whatsoever. This is a chart, the fertility rate in Europe. A little bit random, but I think it does talk to some of the geopolitical issues. Effectively, pretty well all of Europe actually is an inefficient replacement rate for the current day population and is sowing the seed for falling population, which is economically not good. So if we think we have problems in Europe at the moment, I have a feeling just wait.
Yeah.
And here's a chart of inheritance flow across different countries as a percentage of national output. So this is looking at France, Britain, US, Ireland, Germany, Sweden. This is the percentage of money transitioning, I believe at death, to the next generation as a percentage of the national output of the country. And like it all was like down near 5% in 1998, but since then there's just been an inflection, except for Ireland. Either no one's dying in Ireland or Ireland's got nothing to transition inheritance-wise. But have a look, everybody else is just up and to the right. The Italians have gone from 5% to nearly 20% of their national output is the value of inheritance changing. I'll skip that one. Ikigai. So for people probably know what this is, but the Ikigai is where you're supposed to be doing what you're good at, right? What you love, what the world needs, and what you can get paid for. And if you can have those circles overlap, that's where you've got that true Ikigai. The problem for a lot of founders is that they miss the last two. Either they build something the world actually doesn't need, or they build something they can't get paid for. Yeah. And they end up concentrating on what they're good at and what they love. But here's a slightly different version of the Ikigai. So this is a series of circles and then different vocations. So problem solving and people skills, that crossover is management. People skills and drinking, that crossover is sales. Drinking and heartlessness, that crossover is a lawyer. Heartlessness crossed over with OCD, that's human resources. OCD with math skills, that's an accountant. And then math skills with problem solving, so those circles loop back, that's engineering. So I saw this. Bon Jovi must be at least 3/4 of the way there by now. I had to think about that, think of the song. We're halfway
will never get
there. I asked my wife if I'm the only one she's been with. She said yes. All the others were 9s and 10s. Now, the reason why I put that joke in there, and Libby has just come home, so because I'm working in the living room, I might try and grab her and get her feedback. OkCupid did a survey. The top chart is how men rate women. And it's a distribution. It's even from their consideration of attractiveness from least through to most. You would agree that that's a pretty normal distribution.
Yeah, normal distribution curve. Yep.
Now, the survey then looked at how women rate men, and 80% are rated below the median distribution. A little harsh, but that's fine. What's interesting is they then looked at the messaging. So again, this is on one platform. Even though they rated below the average, the majority, their messaging patterns were more normally distributed, meaning what the study took away was that, meaning that they were more willing to engage with people that they rated as less attractive. Now, as a Tinder success story, myself, she's disappeared on me because I was going to try and validate that. Am I also on the lower end of the normal distribution?
I'll leave you to have that conversation in private, I think.
So,
Jeez. Oh dear.
This is what happens when Ash is not here.
Yeah.
What are we
What are you
looking
looking forward to, Don? Oh, you go first.
Oh, the mission coming up. We had was today the first mission call with all the participants?
With the majority. We had a bit of a Q&A session before, but the first proper pre-mission workshop.
Yeah, I think it's going to be a great cohort. I'm really excited for what they're going to learn, because in that conversation, they ask questions or they share what they're struggling with, and it's exciting to go, oh, you're going to get that answered. Oh, you're going to learn this and that. And it helps us really get that focused. And what's good on this one is we've got a good group of investors coming as well.
Yeah, I'm really looking forward to that dynamic in the group, the mix of investors and founders. And it's going to come around super fast. It's not long until we take off. The other thing I'm looking forward to is being in Sydney tomorrow with our fundraising efforts and starting to kick that off.
Yes.
So early start.
I got to connect the generator to the washing machine to do some washing, and then plug the iron in so I can iron my jacket.
Yeah, that's right. You're without power. Yes. Got to dress up.
So no, it's going to be good. All right. Well, we got no Jack, no Ash. Let's wind it up.
All right. Thanks, buddy.
See ya.
See ya.